Good evening, guys. Good evening, Ashwin. Good evening, Vijay. Good evening, Anita. Welcome again to the third session on revision. In the previous class on partnership, we covered aspects around valuation of goodwill. We'll be continuing from that. In the meanwhile, if someone has any question, any query which you want me to take up from the previous class that we had discussed, please let me know. Please post it in the chat box. If you're not able to post, you just need to subscribe to the channel and you'll be able to post the query. If anyone is not able to post a query, you just need to subscribe and then you will be able to post the query, right? If you have any queries specific to what we have discussed, let me know. I'll wait for a couple of minutes and then we will start off with the session. Good evening, Sugam. Okay, so what we learned in the last class was about how to calculate goodwill, and we took up a problem where we calculated old profit sharing ratio, new profit sharing ratio, and distribution of goodwill. And I told you that if you are comfortable with that, in both the cases you will be awarded marks. You need not worry about that. Okay, now today we'll move on to the next step, that is, we'll cover the broadly the aspects that you need to understand and few things that you need to keep in mind in the next three chapters, that is your admission, retirement, and death. And friends, please note, this chapter on partnership will be continued in CA Intermediate, where you will be learning about dissolution and amalgamation. So valuation of goodwill, revaluation account, partners capital account, all of these things you cannot forget. You have to learn, you have to make a solid base now, so that when you read CA Intermediate, you are able to, when you reach intermediate, you are able to handle the questions properly. Okay, regarding annuity, what is the doubt? Over and undervaluation of opening and closing stock and such adjustments relating to unusual items. So, goodwill related valuation aspects, I will come to it slightly later because these are not frequently tested in the examinations. Okay, first what I'll try to make you comfortable is with the aspects around admissions, retirement, and death of a partner. Then this specific aspect around how to calculate goodwill, and if there are abnormal items, what is to be done, that will come to it towards the later part. Maybe today's session I don't think it will be able to cover. In the next session definitely I will cover that. I have slotted time for it. Okay, then right, so thanks. So let us continue with the next thing, which is on, just a second, where is the cursor? So this was on goodwill. Okay, so revaluation. Okay, now when there is a change in the constitution of partnership, that is, a new partner comes in or an existing partner goes out. Now existing partner going out can be because he has retired or maybe the partner has died. In either of the cases, partners have gone out. So there can be an incoming partner or there can be an outgoing partner, and whenever such reconstitution happens, we need to ensure that the continuing partners or the leaving partner or the incoming partner, they get a fair share. Now what do I mean by that? I'll tell you one simple logic and then we'll take up the revaluation account step by step in detail to ensure that 3 to 4 marks in revaluation account you do not lose in the examination. Okay, now say for example there is a firm and there are two partners A and B. Okay, and this firm has a land, and this land was purchased years back at some when the rates were very low. Let us say it was purchased at 1 lakh. Now if the land was purchased at 1 lakh at that point of time, and let us say A and B are 50-50 partners, so he has 50%, this person has 50%, or 1:1. So they purchased 1 lakh, and let us say this is 50,000 was his share and 50,000 was his share overall. Okay, now after 10 to 15 years, they admit a new partner. And when the new partner comes up, let us say they continue to have the same profit sharing ratio equally. So new profit sharing ratio is A, B and C. It is, because it is equally, I'll say 33.33%, 33.33% and 33.33%. 0.01% is my share. Okay, don't say that it is only 99.99%. Now, this land that the entity had purchased at that point of time was at 1 lakh, but today the land is worth 15 lakhs. The land is worth 15 lakhs. On the date of admission, today's value is 15 lakhs. Now, if you were one of the partners or you were the existing partners, you would obviously not want to share anything out of this 15 lakhs with the new partner, because we purchased the land 10 years, 15 years back. We put in capital at that point of time. That land has gone up in value. Why should we give this to the new partner? Why should we share this land with the new partner? Correct. So, what the partners will do is, there is an appreciation of how much? There is an appreciation of 14 lakhs. 14 lakhs is the gain, unrealized gain. They have not yet realized, but it's a gain. So what the partners will do is, this 14 lakhs is our gain. 14 lakhs is our gain. We will not give anything to the new partner. We will not give anything to the new partner. And that is where the entire story of revaluation comes in. Now the new partner will also have questions. Lot of machines, lot of plant and machinery that you are showing in the books, they are not at proper value. So I will not take the loss on those assets. Maybe there is a bad debt. Debtors are 1 lakh, 10,000 is bad debt. The new partner will say, whatever are the assets, whatever are the values up to my date of admission, I am not bothered. Gains you keep, losses also you keep. If there are any new liabilities, you settle. I will not take the burden. Who will not take the burden? New partner will not take the burden. Similarly, when a partner is going out, the existing partner would say, for example, take another case, they purchased a Mercedes, okay, at 30 lakhs is the value, cost, okay, and they have been depreciating at some rate and it is being shown at the books. Let us say the book value is 25 lakhs, right? Now, when one of the partners is retiring, let us say there are 3 partners and one partner is retiring, and they got to know that this Mercedes is worth only 15 lakhs. The Mercedes is worth only 15 lakhs. So the continuing partners will say, boss, this Mercedes which you are showing in the books at 25 lakhs, it is only 15 lakhs. There is a loss, unrealized loss of this 10 lakhs which you have to bear, which you also have to bear. We will not be the person only to bear, you also need to bear. So the whole crux of the matter is, you have to see what is the date of reconstitution. Okay, you have to decide what is the date of reconstitution. In our exams, thankfully, reconstitution happens either at the end of the year or at the beginning of the year. Okay, so say it is on 1st of April of 22. Now, all gains, losses up to 31st March belong to existing, or I'll say belong to old partners. It belongs to old partners. So that is why this whole story around revaluation comes up. Now what are we trying to do here? Let me take you to the first example where I said 14 lakhs is the increase. Who owns this increase? Whom does this increase belong to? The existing partner A and B. So A will say, out of this 50% is my share, B will say 50% is my share, 7 lakhs they will distribute. Now we can do this for individual assets. And do the entries in the capital account, but then it will be a lengthy thing to do. So for that, what we do is we create something called revaluation account. So we create something called revaluation account. Now what do we do in this revaluation account? Now say for example this building. Land cost was 1 lakh. Today's market value is 15 lakhs. So there is an unrealized gain of 14 lakhs. The asset value has increased by 14 lakhs. This you will bring it to the revaluation account. How will you bring it to the revaluation account? Remember, whenever the asset value increases, you debit the asset. Now, because asset value has increased, there is a gain. Now, this gain you will credit to revaluation account. So, here you will say buy land 15 lakhs minus 1 lakh. Please note, friends, to write this thing in the exam, in the brackets, the percentage, 10% of plant and machinery, whatever is the thing, you write it in the bracket so that it, the examiners knows that you have done it properly. Okay, so this will be 14 lakhs. Okay, now this gain belongs to what? Belongs to the partners. So when this gain belongs to the partner, what will we say? 14 lakhs is again, assume there are no other transaction. So two partners capital A and B. Revaluation gain. How much is the revaluation gain? 50% of this 14 lakhs multiplied by 50% and same thing. So you will credit. Sometimes you get confused. Sir, should we debit it to revaluation account? Should we credit it to revaluation account? Think of this account as your P&L account. Think of this account as your P&L account where you are posting all your unrealized gains and losses because of revaluation, or sometimes even realized because of revaluation. Whatever comes up will come to this revaluation account. You will have all gains this side, all losses this side. All gains on the credit side, all losses on the debit side. Sir, asset value came down, debit the revaluation account, because asset value coming down is a loss. Sir, there is a new liability which we had to pay. This is one very favorite question of the student. Unrecorded liability now paid 5,000. Now what is this? A liability was not recorded, means liability is right now at zero. And we paid 5,000 for that. If 5,000 is being paid to settle a liability which did not exist, means what? Is it a gain or a loss? It is obviously a loss. So if it is a loss, you will debit the revaluation account and credit what? Credit bank account if you paid. So revaluation debit to bank. Or if they say unrecorded liability brought into books. Unrecorded liability brought into books, let us say 10,000. So there was not a liability was at zero. Now you have to record a 10,000 of liability. So what will you do? You will credit the liability and you will debit revaluation. Think of it as a P&L for assets and liabilities revaluation. Losses debit, gains credit. Whatever is the balancing figure will be transferred to the partner's capital account in which profit sharing ratio? Sacrifice ratio or old profit sharing ratio? Can you please answer? The gains or losses on revaluation will be transferred to partner's capital account in their sacrifice ratio or old profit sharing ratio. Sir, what simple questions? I'm asking this question to ensure all of you are awake, not sleeping afternoon time. Old profit sharing ratio or sacrifice ratio? Old profit sharing ratio. I know all of you know it, but I just asking to gain loss to be borne by old partners only or existing partners, old partners that is. In the old profit sharing ratio, don't get confused with sacrifice ratio. Are we clear? Right. Now, one more kind of trick what examiners play or sometimes they ask in the question is, we will do revaluation, but we will not change the value of assets and liabilities in the balance sheet. Meaning to say, we will bring this asset to what? We'll consider that the land is worth 15 lakhs, but in the books, we will not show it at 15 lakhs. We will show it at 1 lakh only. We will not show it at 15 lakhs. In such situations, when assets and liabilities are not to be revalued, what do? We prepare something called as Memorandum Revaluation Account. We prepare something called as Memorandum Revaluation Account. Now what do we do in this memorandum revaluation account? First, by all increase in assets, by all decrease in liabilities, to all increase in liabilities, to all decrease in assets, right? Normal revaluation account. Then gain or loss to partners in OPSR. In old profit sharing ratio, you will transfer the gains and losses. Then, because you do not want to show the increased value of assets in the balance sheet, you have to reverse whatever you have done in the first step. So here what you will do is, whatever is appearing here, you will again debit it to revaluation account this side, and whatever is appearing here, you will pass it on this side. So what you will do is, basically, to increase in assets, to decrease in liabilities. Please don't write increase and decrease. Please write 2 assets and 2 liabilities. By increase in liabilities, by decrease in assets. Right? Now you will do this. You will do the entire reversal. Then whatever is the gain or loss, this will be transferred to continuing partners or new partners, all partners you can say, in new profit sharing ratio. So whenever you are preparing a memorandum revaluation account, what you will do is, you will first prepare the gain or loss, or compute the gain or loss, and you will transfer the gain or loss in old profit sharing ratio. After that, whatever was the gain or revaluation you did, you will reverse that, and the gain or losses will be transferred to all the partners in new profit sharing ratio, so that the value of assets and liabilities, they do not change in the balance sheet. Okay, this is one thing which all of you must keep in mind. Sometimes institute does test the question on memorandum revaluation. I have not seen much, but sometimes they do test, so please keep this in mind. Any questions so far? Please feel free to ask. I will otherwise I'll continue with the next part. Okay, no questions asked. Now, so we'll take now specific aspects on admission of partners, then retirements of partners and all of that, right? Now also few things that we need to keep in mind is, whenever there is an admission, so let me just write it down. Whenever you get a question on admission or retirement or death of a partner, few things that you should not miss. One is there anything good related to goodwill? Definitely there will be something. Goodwill, either prepare a table or do the sacrifice ratio. Straightforward. Then revaluation. Now in revaluation, what you need to understand is, you have to read the adjustments properly. Whether it is a percentage, whether it has increased to, whether it has increased by. Right, students, they sometimes misread the adjustment, and that causes them to lose marks. So that you should not do. That kind of error you should not be doing. So read the adjustments clearly. I'll take you through some of the adjustments. I'll take you through actually some of the past exam papers or RTPs also, which will help us understand how do we read those questions. Okay, that is one thing. Then revaluation you have to do. Always it is in OPSR, old profit sharing ratio. Please see if there is a memorandum revaluation account requirement or not. Then there would be sometimes reserves. This reserves, whom does this reserve belong to, by the way? All partners or old partners? The reserves belong to whom? Does it belong to the old partners or to the new partners? Reserves belong to old partners, so this also has to be transferred in OPSR to the old partners. Okay, don't miss this. Sometimes you may miss in a hurry, you will not read the balance sheet properly, and suddenly you realize that there is a reserve fund and you have not transferred, so it will be missed. That is one thing. Then, if at all there is a current account balance, now this current account balance, this I'll just put admission and retirement also together. If there is a current account balance, then this will be transferred to capital account of outgoing partner. Okay, so it will be transferred to capital account of outgoing partners, right? Okay, now, so reserves you have to consider, profit and loss on revaluation, and then goodwill amongst the partners. That is what you need to consider. Okay, no need to by heart these entries. From theory also not much will be tested. Then we talked about when revised values are not to be recognized, you will have to create something called a memorandum revaluation account, right? So what I'll do is I will take you through an RTP. Let us have a look at an RTP question. Okay, now let us see how do we read these questions. And generally the trend has been to ask 10 marks question from this chapter. Again, revaluation account will carry around 4 marks, partners capital account 3 to 4 marks, and balance will go for our workings. Again, here this is one chapter, as I told you, even in NPO, and even here, even if you don't know the full answer, you will be able to do it properly. Okay, so that is one thing which you should be clear about, right? Okay, now Acme and Company is a partnership with partners A, B and C. So don't worry about this name. What you are worried about is A, B and C. Sharing profits and losses in the ratio of 10:6:4. So which will translate into 5:3:2. The balance sheet of the firm as at 31st March 2021 is as under. So the balance sheet of the firm is given below, right? What is the balance sheet of the firm looks like? Yeah, so if there is a current account, you can pass it through current account also, not a problem. So, and then finally, whatever is the current account balance, you'll transfer it to capital account of the outgoing partner and close it. Right, now, when you read it, you see that capitals A, B and C, the capitals have been given. Reserves. Now, please note this reserves, even if the question does not mention anything, this reserves will be distributed in the ratio of 10:6:4. Then, long-term debt is given, bank overdraft is given, land, buildings, plant, furniture, investment, inventory, trade receivables, then trade payables, balance sheet is tallied. Now, it was agreed. Now, see, this is slightly tricky question, a longer question, and if you practice this, it's sufficient. It was mutually agreed that B will retire from partnership and in his place, Mr. F will be admitted as a partner with effect from 1st April of 2021. So, there is an admission as well as there is a retirement. Who is retiring? B is retiring. Who is getting admitted? F is getting admitted. For the following purpose, following adjustments are made. First, goodwill is to be valued at 3 lakhs, but the same will not appear as an asset in the books of the reconstituted firm. Now here, even if this is not mentioned, okay, even then you will not recognize or show goodwill in the books, right? So even if goodwill is, they say that goodwill not be written off or they will not show whatever it is, goodwill will not be shown in the books. Never, never, never it will be shown in the books unless money has been paid to acquire goodwill. Okay. Then building and plant and machinery are to be depreciated by 5% and 20% respectively. Investments are to be taken over by retiring partner at 45,000 and provision of 20%. Oh my god, 20% provision. Oh my god, 20% provision is to be made on trade receivable to cover doubtful debts. Now, line by line. Building and plant and machinery to be depreciated 5 and 20. It's a simple adjustment. Investments are to be taken over by the retiring partner. Who is the retiring partner? B. So, B will take over the investments at what value? They have agreed that investments will be taken over at 45,000. So what is the investment value in the books? 36,000. So from 36,000 to 45,000, 9,000. 9,000 is the gain, revaluation gain on investment. And who will take over these investments? These investments will be taken over by the outgoing partner. Okay. Then in the reconstituted firm, just a second guys, I'll just come back in a moment. No, I think it is fine. Yeah, I'll just take a break. No, it's fine, I'll continue. Yeah. Now, in the reconstituted firm, the total capital will be 6 lakhs and it will be contributed by C. A, B and C. This kind of errors you get in the question. So you have to be very careful. A, B and C. C is retiring. Why will C contribute now? It has to be F, right? So you have to make an assumption. Okay, you have to make an assumption because they say the total capital of 6 lakhs will be contributed by A, B and C in their new profit sharing ratio of 2:1. So this is not C, this has to be F. If I understand it, this has to be F. In the exam, don't get scared or don't get worried, just write a working note saying that it is assumed that the in point number C, it is Mr. F and not Mr. C. Okay, such kind of errors sometimes happen in the question. In fact, once what they did was they asked a question based on AS 28 instead of Ind AS. So they did some kapla and then it was difficult for the students. This is a simple error which you can identify. If there are errors which you cannot identify, please leave that question and move ahead. Don't break your head on that. Okay. Is it buffering? I think it's better now. Yeah. Right. Then what does it say? Surplus funds, if any, will be used to repaying bank overdraft. So if they have any surplus fund left, that will be used to pay bank overdraft. Amount due to the retiring partner shall be transferred to his loan account. So you are not paying the retiring partner immediately. You are required to prepare revaluation account, partner capital account, bank account and balance sheet of the reconstituted firm. Now whenever you get these kind of questions, lengthier questions, revaluation leave one page. Partner's capital account, if it will not fit in the normal vertical format, you can do it horizontally, no problem. Okay, or you can do it over, don't do it over 2 pages because digital valuation made is difficult sometimes. Then bank account, you can leave half a page, balance sheet half a page and you are done. Okay, now what do we prepare here first? See, goodwill is a very simple adjustment for which we will need to prepare a working note and revaluation account. So we'll start with revaluation account. Revaluation account. Now what are the revaluation items you have to consider? Buildings, plant and machinery to be depreciated by 5% and 20%. So building 5%, plant and machinery 20%. Depreciation means reduction in value, loss. So to buildings 5% off to plant and machinery. Don't write P&M, please write plant and machinery. Okay, I am teaching, so I can write in the exams. You are not supposed to write it. At least write plant and machinery. 6 lakhs and 3 lakh 90. So it is 20% of 3 lakhs 90,000. 5% of 6 lakhs. Okay, so how much will this be? 6 lakhs multiplied by 5%, 30,000, and 3 lakh 90,000. 20% will be some 78,000. Yeah, 78,000. So these two are the losses. Then investments is 36,000 and they mentioned something no in the question. Investments to be taken over by the retiring partner at 45,000. If you are not able to see this, okay. Yeah, investments to be taken over by the retiring partner at 45,000. Here in revaluation, you will only do the revaluation. When it is transferred, that entry will come in capital account. That entry will not come in revaluation account. Okay, so 45,000 means what? From 39 or 36? From 36 it has gone up to 45,000. So it's a gain by investments. You are basically increasing the value of investments. 45,000 minus 36,000, 9,000. Okay, then the question mentioned about provision for bad debts. Provision for bad debts, 20% of 4,17,000. 4,17,000. So which is 4,17,000 into 20%. How much you get? 83,400. Simple, nothing complicated, right? Then is there anything else in the revaluation adjustments? There are nothing else in the revaluation adjustments. We have done those 4 entries. Okay, done. So there is a loss. Obviously there is a loss. So what you'll do? You will sum this up. And loss. By loss transferred to capital account. Okay. So you'll have A, B and C. I think the ratio was 10:4:6. 6:4. 10:6:4. So 10:6:4 means 10 out of 20, 6 out of 20 and 4 out of 20. So how much is the loss? 1,91,400 minus 90,000, you get 182,400. So this will be 10 out of 20 multiplied by 182,400. This will be 6 out of 20 multiplied by 182,400 and this will be 4 out of 20 multiplied by 182,400. Okay, so if you do this sum, you get 182,400, right? Now this will be taken to capital account. Now by the time you reach the end of this, start posting in the partners capital account also. So we'll prepare the partners capital account as well. Now here please note we have 4 partners. So A, B, C and F. A, B, C and F. Okay. Now when you start partners capital account, first balance brought down. First balance brought down. I am not writing to and by due to lack of space. In exam, you can please write by balance brought down. Okay, what is balance brought down? 240, 60 and 90. 60 and 90. Okay, 240, 60 and 90. Then do they have bank balance? Have they given something? No bank balance. So we will directly post everything in the bank overdraft account itself. Okay. Then 240, 60 and 90. What did the question exactly tell us? Prepare bank account. So we'll prepare bank account and transfer that to bank OD account separately. That also can be done. Okay. So 240, 60 and 90. Then reserves 60,000 to be distributed. So reserves in the ratio of 10:6:4. How much is that? 60,000. 60 by 20 is 3,000. So 30,000. Then 18,000. Then 12,000. Okay. See, if you can calculate these numbers quickly, no, you will save some time. For example, it is 60,000. 60 by 20 is 3,000. So 3 into 10, 3 into 6, 3 into 4. That saves time. Calculator may, if you do come back post, it makes it difficult. Right? Then revaluation loss. So revaluation loss we calculated here, you post it here directly to revaluation account. How much is that? 91,200, 54,720 and 36,480. Okay, so this is done. Then goodwill. Now because we are done with this adjustment, now we have to look at goodwill. Now what is the goodwill treatment? Goodwill treatment is that they have valued the goodwill of the firm at 3 lakhs. They have valued the goodwill of the firm at 3 lakhs. Now there is an admission, there is a retirement. How do we handle this? Very simple. Distribute goodwill in the old profit sharing ratio and write off the goodwill in the new profit sharing ratio. It will be taken care of automatically. Okay, so working note, goodwill, value of goodwill is 3 lakhs. Distribution of goodwill in OPSR, old profit sharing ratio, A, B, C and F. What is the old profit sharing ratio? 10:6:4. Now 30 by 20 is 15,000. So 15,000 multiplied by 10 is 1,50,000. So basically what I am doing is 30 divided by 20 multiplied by 10. Okay, 1,50,000. Then here 30 divided by 20 will give you 15,000, multiplied by 6 is 90,000, and 30 divided by 20 is again 15, multiplied by 4 is 60,000. Okay, this is distribution in old profit sharing ratio. Write off in new profit sharing ratio. What is the new profit sharing ratio? 2:2:1. 2:1. Again, 3 lakhs is the goodwill, right? You will write it off in the ratio of 2:1. So what do? 3 lakhs divided by 5 is 60,000, multiplied by 2 is 1,20,000. Here B, again 1,20,000. 120 plus 120 is 240. Here it is 60,000. Okay. Now what is the difference? 150 minus 120, 30,000 credit, 30,000 debit. So we'll debit B by 30,000. Then credit C by 60,000. Debit F by 60,000. Right? So net entry. Whom will you debit? You will debit because B's share has increased, F share is new, so you will debit these two items, 30 and 60. So debit B and debit F to A to C. How much is B's account debit? 30,000. How much is F's account debit? 60,000. How much is A's account credit? 30,000. How much is C's account credit? Sorry. This is actually for C. B has retired. See, you can do mistakes in the exam. So B will be credited, not debited. So C will be debited. C's account debit 60,000. F account debit 60,000. A's account credit 30. C's to B 90. Okay. So this is how you will pass the net entry. And once you pass this net entry, please post this net entry in the account. Now who is getting the credit? A and B. Correct? A and B are getting the credit. So by C and F, A got a credit of 30,000, B got a credit of 90,000, and on the debit side, to A and B, C 60,000, F 60,000, right? Then I think we have covered everything. See, investments are to be taken over by the retiring partner at 45,000. So you will give investments to whom? B. So when we are giving investments to B, what does that mean? investments are going out, so credit investment, or asset is going out, credit asset. Partner is taking away, debit the partner. So to investments, who is taking it up? B. At what value? 45,000, right? So now with this, we have done all the entries that are required. We have done revaluation, we have done goodwill, we have done assets taken over by the partners. Now what the question says? The question says that the reconstituted firm, the total capital will be 6 lakhs, which will be contributed by A, B and F in the ratio of 2:2:1. So now the total capital in the firm will be 6 lakhs only, right? 6 lakhs will be contributed by 3 in the ratio of 2:2:1. So what you can directly do here is 2, or you can leave a space, 2 balance carried down. What is the ratio? 2:2:1 for 6 lakhs. Okay, so A will have 2 out of 5, 2,40,000. B will have nothing. What will you do? Whatever is outstanding to B, you will transfer to loan account. We will calculate that number. Then C will have 2,40,000 of capital balance, and F will have 6,1,2,1,2,3 divided by 5, 1,20,000 of capital balance. Right? That is what it means, correct? Total capital will be 6 lakhs, which will be contributed by A, B and C in their new profit sharing ratio 2:2:1. So the closing capital will be in this ratio, which means if there are any balancing figure, that balancing figure will be contributed by the continuing partners. Whatever is the amount is left, they will contribute or they will withdraw. Right? Now, let me add some lines here. Now, if I total up, the credit side is 3 lakhs for A, and here if I see, it is 331,200. Basically, if you see 3 lakhs minus 3 lakhs is on the credit side and 3,31,200 is on the debit side, means credit side is shorter, credit side has shortfall, which means A has to bring in capital. So what will A do? A will bring by bank how much? 331,200 minus 3 lakhs. So 31,200 will be 31,200 will be brought in by A. What I am trying to tell here is A has a total credit of 3 lakhs and there is a revaluation debit of 91,200. So otherwise, if you want to do, A's capital is 3 lakhs minus 91,200. You get 2,08,800. What is the required? Required capital is 240. So A will bring in 240 minus 208, 31,200, right? So A will bring in 31,200. Let us look at the same way for B. 168,000, 99,720. Balancing figure will be transferred to the loan account. So 168 minus sum of these two. 68,280 will be transferred to loan account. Then coming to third partner C. What is the total? Total of credit is 1,02,000 and we need the closing balance as 240. So it also has to bring. He also has to bring. So on the debit side you have 336,480. On the credit side you have only 1,02,000. The balancing figure will be brought in by bank. So it will be 336,480 minus sum of these two, which gives us 234,480. Will be brought in by whom? Will be brought in by C. And what will F bring in? F on credit side there is nothing. On debit side there is 180. So F will bring in 180. So basically what will happen is, after this, for all the adjustments, the closing balance of the partner's capital account will be 6 lakhs, right? Now, what is the question asked us? Next, prepare the bank account. So let us prepare bank account. In bank account, there is no balance brought down. So whatever is the contribution to A's capital, to B's capital, no, nothing to B's, to C's capital, and to F's capital. Okay. Now to A's capital, how much is A bringing in? 31,200, 23,400. So these are the three numbers. You can copy it directly in the exams. So that there is no rocket science there. Two, 3, 4, 80 and 1,80,000. This is what is brought in. Okay, 445, 680. And the surplus fund will be used to repaying bank overdraft. How much is bank overdraft? Bank overdraft is 1,32,000. So the surplus fund you will pay bank overdraft. Now when I am paying bank overdraft, I am repaying a loan. I am reducing a liability. So I will debit the loan account or the overdraft account and credit my bank account. So by bank OD, how much is that? 132. Okay. So what is the balance carried down? 445, 680 minus 1,32,000. You will see 313,680 is the balance in bank. Now, the last thing is to prepare balance sheet. I am not preparing that. I'll just take you through the balance sheet given in the solution. When we are preparing balance sheet, things that you need to keep in mind. One, this whatever is the balance in B will go to B's loan account. Second, reserves will no longer exist unless the partners agree to retain the reserves. Then you may again write it back and all of that can be done. But otherwise, generally it will not be retained. Then bank overdraft will be out. Buildings depreciated. Plant and machinery depreciated. Investments will no longer exist because the partner has taken over. Trade receivables minus provision for bad and doubtful debt. That's it. And based on that, you can prepare the balance sheet. The partner's capital account will be at 6 lakhs. So I'll just take you through the balance sheet. This is question number 15, right? Right. So if we do it right, 180 to 400, 180 to 400. This, so for this much of effort, right, this revaluation account, you will get about 3 marks. This much will have 3 marks. Okay. Then partner's capital account. $31,200, 234,480 and 1,80,000. And this has how many entries? 1, 2, 3, 4, 5, 6, 7, 8. This will also be around 3 to 4 marks. Then bank account we did, and balance sheet is simple and straightforward. I am not repeating. See, I don't know where do they copy this question from. They have got it Q's loan account. It's actually B, and new entry, balance and bank. Now think of it, when you are preparing this balance sheet, half of the items you have to copy from the existing balance sheet. Okay, so there also will score marks. So please keep your head cool, please be calm and ensure that you solve these kind of questions in the examination and score whatever is possible. And I have seen past exam papers also. I did not find any complex question in the last 5 attempts that has been asked in the partnership accounts, right? Sometimes study material or practice questions are tougher, but generally you see 10 marks question easily attemptable again. Need not be a cause of concern for you guys. Any questions? I've been speaking non-stop for 25-30 minutes. Any question, any specific adjustment in partnership admission? See, I took you through a process so that you know how to attempt that paper in the examination. So whatever we did in the last 15 to 20 minutes, you understand the step by step process with the help of which you have to do it in the examination, and See, we have taken admission plus retirement, so tougher goodwill adjustment is done. Then how to derive at the closing balance of partners capital account, that is also done. Balancing figure will be drawn in by bank or it will be paid out to the partners, that is also done. Okay, investments taken over a partner, that is also done. Anything specific you want me to cover, please let me know. Okay, right. Now, one thing that you have understood by now is I'll take you through a couple of past exam papers also. It is on death. Okay, get confused between to and by. Machinery 235 100 means what? What is the question? 30. Okay, 30. From 30 you are taking it to 35 100 means revaluation gain of 5100. Sometimes they say machinery by 35 100. When they say by 35 100, then entire amount is revaluation. When they say 235 100, then it means that machinery has to be brought to 35 100. If they say by 35 100 increased by 35 100, then entire 35 100 is the gain. Okay, so furniture and inventory, very clear. Goodwill was valued at 18,000, simple. 6,000 to be paid away to the executors of the dead partner on 8th April. So 6,000 was paid. Okay. After that, Ria, Tina, and Meena were to share profit equally. So nothing complicated out here. Okay. Tina, Meena, Rita. Rita died. Tina, Meena, Rita. How will Tina, Meena, Rita share profit equally? Again, error in the question. Let us see what they have taken in the solution. I think only two partners will be left, no? I don't know, instead after being in profession for so long also, they don't do proper sense check. Right, so it's only Tina, Meena, right? Rita is not there. So again, you can do it this way. This is slightly complicated. You can directly do a revaluation basis. That is fine. Right, now let us look at exam papers. Let me see what were tested, so that will help us understand. Okay, now coming to partnership, generally tested at 4B. Admission, so there is a revaluation, then death of a partner. There is a death of a partner, retirement of a partner, and again death of a partner. So one of these three things coupled with revaluation. So if let us say we take up December 21 paper. December 21 paper, if you see, it was in question number 4, right? 4, 3, 4. Income and expenditure, yeah. A and B were partners. I hope the screen is visible, or let me increase the size. Yeah. I'll quickly take you through the problem and also the solution, so that you are able to understand what kind of adjustments are we supposed to do. Here we come. A and B were partners, sharing profit and loss in the proportion of 3/4 and 1/4. That is what, 3:1. As at 31st March, the following is the balance sheet: capital accounts, creditors, general reserve, Cash in hand, cash at bank, sundry data, stock, BR, lands and building, and office furniture. They agreed to take C into partnership on 1st of April of 2021. So that is the date on which the partner is admitted. Goodwill is to be valued at 2 lakhs. C is unable to bring cash for his share of goodwill. So it was decided that due credit for goodwill be given to A and B for their sacrifice in favor of C through C's current account. They have told specifically that whatever is the share that you will credit through or that you will handle through current account of C. Okay, then C pays 1,40,000 as his capital for 1/5 share in future profit. So the future profit share that C gets is 1,40,000. It is 1,40,000 for how much share? 1/5 share. Then stock and furniture to be reduced by 10%. So whatever is the value of stock and furniture by 10%. Provision for 5% on doubtful debt to be created. So whatever is the data on that, you create 5% doubtful debt. Land and building to be appreciated by 20%. You can do that. Capital accounts to be readjusted on the basis of their profit sharing arrangement, and any excess or deficiency to be transferred to their current accounts. Now here they are not withdrawing. If at all there is any surplus or deficit, you move that out from the capital account to current account. Now friends, what you need to understand here is, first, they have not told us the new profit sharing ratio. Then what will we assume? We will assume that the partners have sacrificed in their existing profit sharing ratio only. So here you have one more step to calculate the new profit sharing ratio. So basically, out of 1/5 is the new partner share, that is C share. Let me just quickly do that. New partner share is 1/5. Balance. So out of 1, if you give 1/5, 4/5 are left. So out of that, who is the what the existing partner? A and B. A, B. A will have 3/4 of 4/5. That will be 3/5. 3/5. Right? Yeah. And B will have 1/4 of 4/5. That is 1/5. 1/5. So the profit sharing ratio is now 3:1:1. Right? So that is what is one thing that is that you have to think. And because 1,40,000 is for 1/5 share, total capital should be how much? For 1/5, it is 1,40,000. So for entire, it will be 5 divided by 1, that is 7 lakhs. 7 lakhs should be the total capital. So that's it. You have to prepare revaluation account and partners capital account, not even the balance sheet. 10 marks question. So revaluation is a simple entry, nothing to be done. Then balance brought down, general reserve you will transfer, revaluation profit you will transfer, then capital has been contributed, then goodwill adjustment will be through C's current account. And in what ratio? Because they have not mentioned sacrifice ratio, the old profit sharing ratio itself will be the sacrificing ratio. That is one way to do. Or if you are confused, what you can do is goodwill OPSR in the old profit sharing ratio. How much is the old profit sharing ratio? 3:1. And what is the value of goodwill? Two lakhs. So we'll give to A, B, multiplied by 3 divided by 4, and this multiplied by 1 divided by 4. You get 1,50,000 and 50. That is for goodwill. Then goodwill written off in what? New profit sharing ratio. What is the new profit sharing ratio? 3:1:1. So 2 lakhs divided by 5 multiplied by 3, 2 lakhs divided by 5 multiplied by 1, and 2 lakhs divided by 5 multiplied by 1. So this minus this, 30, 10, 40. So credit 30 and 10, and where will you debit this? You will debit this to the partner's current account. You will debit this to the partner's current account, and you are not even required to prepare partner's current account. See, what a simple question. Then calculation of total capital, we derived 7 lakhs. Based on that, we will do the adjustment. New profit sharing ratio also we calculated. Either ways you want to do. Goodwill, they have done the net entry. You can do it on the basis of this. You can prepare a table and then pass this entry, or directly do it on the basis of sacrifice ratio. Now a 10 mark question. 1, 2, 3, 4, 5. So around 3 marks for revaluation. 1, 2, 3, 4, 5, 6, 7, 8. Around 4 marks here. 7 mark, 8, 9, and 10 marks. 10 out of 10 marks in your pocket. So don't be scared of this chapter called partnership. See, we'll taking up more adjustments related to death, joint life policies, and one goodwill what one of you wanted me to discuss. That will take up again on Friday. But what I wanted to tell you is, don't run away from this chapter, because see, sometimes a tricky adjustment comes up, but again, most of the questions from partnerships are also attemptable in the examination. You can at least pocket 6 to 8 marks easily, and in questions like this, I think 10 out of 10 should be in your pocket. So 10 from NPO, 10 from this, and some average due date here, and some account current there, and that takes care of the overall marks. And PN final accounts is also kind of highly scoring. When we come to that, we'll understand few tricks and tips to ensure that we don't lose marks on that as well, right? So we'll conclude the session here. Any questions, I will catch up. Direct amount of buildings. No. See, in while preparing balance sheet, you have to write total amount less, revaluation loss, net amount. It'll take just 2 minutes extra, because 3 or 4 revaluation entries. No, so please write 6 lakhs minus 30,000, 5 lakhs 70,000. Okay, look, is a better presentation, and I'll tell you, these are the questions where you will score many marks. Most of the marks will be, you'll be easily able to score in these kind of questions, right? Thanks for your time again. See you again on Friday, continuing with where we left today. We'll be covering aspects related to death, one tricky concept called joint life policy, and one of the concepts related to goodwill, and then we'll move on to the other chapters next week onwards. Okay, so thanks a lot, and have a great time. Revise well, read well. Now that we have completed a lot of things around partnership and NPO, please ensure you revise them or practice questions on them. That'll give you more confidence. Okay, chalo. Thank you guys. Thank you, Ashwin. Thank you, Mahalakshmi.